Have you ever seen the market pull back and wondered if it's the end of the trend or the perfect chance to enter? What if I told you there's a secret price action pattern that professional traders use to spot continuation setups with laser precision? In this video, I'll break down a powerful 1, 2, 3 bottom continuation pattern on the weekly time frame using this exact chart and show you step by step how to identify, confirm, and trade it like a pro. Stay with me because what you'll learn here could change how you look at retracements forever and help you stop second-guessing your trades. In this chart, we're looking at a perfect example of a bullish 1, 2, 3 bottom continuation pattern playing out during a strong uptrend. The price had already been rising with strong bullish candles when a natural pullback occurred, and that's where most traders get nervous. But this pullback isn't the end of the move, it's the beginning of a high probability opportunity. The lowest point of this pullback is labelled as point 1, the temporary bottom after the correction. As price recovers from point 1, it rises but gets rejected around a swing high. That's point 2, and this becomes our resistance zone. Many retail traders get trapped here trying to short, thinking the trend is reversing. But smart traders watch what happens next. The price pulls back again, but this time it doesn't go as low as point 1. Instead, it forms a higher low. This is point 3. This shift tells us that buyers are stepping in earlier, absorbing selling pressure and preparing for a continuation. Now here's where it gets exciting. When the price breaks above point 2, it confirms that the bulls are in full control. This breakout is the entry signal that many professionals use because it shows a clear structure shift in favor of the trend. In the chart, this breakout is labeled as a high confirmed pattern, and you can see the result. Price shoots upward aggressively after the confirmation, continuing the dominant trend. Even more confidence comes from Fibonacci confluence. Notice how point 3 aligns perfectly with the 78.6% Fibonacci retracement level. That's not a coincidence. This level is known as a deep retracement zone, where institutional buyers often accumulate positions. So this confluence between structure and Fibonacci adds weight to the setup, giving you a high probability trade with minimal risk. Traders entering at the breakout of point 2 can place stop losses just below point 3, making this setup extremely efficient in terms of risk-to-reward ratio. Targets can be new swing highs or extended using Fibonacci projections. As seen in the chart, once the breakout happened, the price exploded, showing that the trend wasn't over. It was just getting started. In the chart you're seeing, we have a clean example of the rounded top pattern, a classic bearish reversal setup. It begins after a sustained uptrend where buyers have been in control, pushing prices higher. But then something subtle happens. The momentum begins to weaken. Prices stop making aggressive new highs and instead start curving, forming a smooth, dome-like shape. This curving top signals that bullish pressure is fading and bears are gradually stepping in. The curved grey arc on the chart illustrates this transition visually. As the top forms, price action gets tighter and more indecisive. The candlesticks become smaller and the highs stop breaking out convincingly. This indecision is a red flag, and it prepares traders for the next key move. At the base of this rounded structure, we identify a clear support level, the horizontal blue line. This is where price has bounced several times before, but this time, as bearish pressure builds, that support eventually breaks. The Trade the Breakout label in the chart marks the critical entry point. This is where smart traders go short, right as the price breaks below the support zone that held during the entire top formation. It's important not to enter too early during the curve, but wait for confirmation of the break. This is the safest entry and gives the highest probability of success. After the breakout, price moves sharply lower, confirming that the rounded top has fully completed and that the trend has officially reversed. The red and green dashed lines represent the measured move target. This target is calculated by measuring the height from the top of the pattern down to the support level and projecting that same distance downward from the breakout point. As seen in the chart, the price almost perfectly reaches that target level, which aligns with standard technical analysis principles. This pattern works best on higher time frames, like 4 hours, daily, or weekly, where volume and structure are more reliable. It's not just about the curve, it's about the story of fading demand, building supply, and the decisive moment when the floor drops. And that's the breakout moment every serious trader is waiting for. Now let's move to one of the most famous and powerful reversal patterns in all of technical analysis, the head and shoulders pattern. This chart clearly shows how the market transitions from bullish strength to bearish domination through a sequence of structured highs and controlled breakdown. At first glance, this pattern may look complex, but once you understand the psychology behind it, it becomes a crystal clear roadmap for catching trend reversals. We start with the left shoulder, which forms as price pushes upward, then pulls back, a normal bullish swing. Then, buyers step in again with more force, creating a higher high, forming what's labeled as the head. This head represents the peak of bullish momentum, but here's where it gets interesting. The next push fails to break the previous high, forming the right shoulder. This lower high tells us the bulls are losing steam. Sellers are stepping in earlier, and the market is getting top-heavy. All three of these peaks are connected by a sloped neckline, which acts as a dynamic support level. Once the price breaks below this neckline, it confirms the entire pattern. This is the key moment for traders. The breakout signals that the bullish trend has officially reversed and bears now control the market. This breakdown is often followed by a strong and swift drop in price, as seen in the chart. What makes this pattern so powerful is its symmetry and the psychology it represents. The left shoulder shows strength, the head shows exhaustion, and the right shoulder confirms weakness. Once price violates the neckline, you have a highly probable reversal setup. Smart traders place entries just below the neckline and use the height from the head to the neckline to calculate the measured move target, projecting that same distance downward. This pattern is trusted by professional traders across all time frames, from intraday to weekly charts, because of how reliably it plays out when formed correctly. It's not just a pattern, it's a narrative of changing sentiment, and once you learn to read it, it gives you a major edge in anticipating trend reversals before the crowd catches on. To wrap up this powerful chart pattern series, let's look at one of the simplest yet most effective reversal signals, the double top pattern. This formation is widely respected by traders at all levels, and for good reason. It gives a clear visual cue when a bullish trend is about to reverse. In this chart, the double top is shown with perfect clarity, and we'll break down exactly how to identify and trade it with confidence. The pattern begins with price making a strong move upward, forming a first peak. After this high is made, the market pulls back to a support level, known as the neckline. Then, price rises again, but this time it fails to break the previous high, forming a second peak that matches or nearly matches the first. This second failure is a crucial clue. It tells us that buyers tried but lacked the strength to push any higher. Momentum is weakening, and sellers are waiting for confirmation. That confirmation comes when the price breaks below the neckline. This is the trigger point, the ideal entry for a short trade. As shown in the chart, the entry is placed just below the neckline, while the stop loss is positioned a few points above the most recent high to protect against false breakouts. The target is determined by measuring the height between the neckline and the peaks, and projecting that same distance downward, a standard measured move technique used by professionals. What makes the double top so effective is its psychological story. The first top is driven by bullish enthusiasm. The second top is a test. If buyers can't make a higher high, it's a sign that the trend is exhausted. Once the neckline breaks, that exhaustion turns into a flood of selling pressure, often leading to strong downward momentum, as we see in the chart. This pattern is clean, easy to recognize, and powerful when it occurs after an extended uptrend. It can be used on any time frame, from 5-minute scalping setups to daily swing trades. And when combined with volume analysis, structure, or confluence zones, the double top becomes one of the most dependable bearish tools in your trading arsenal. So here's what we've learned. Whether it's the 123 bottom for continuation, the rounded top and head and shoulders for reversals, or this double top for trend exhaustion, mastering these patterns is like learning the language of the market. These aren't just shapes on a chart. They represent real human behavior, decision-making, and institutional movement. And if you can read them correctly, you'll be entering trades not with hope, but with strategy and confidence. If this full breakdown of market structure and chart patterns helped you level up your trading game, subscribe now to Financial Freedom FX, hit that like button, and comment Pattern Master if you want me to do a part 2 with more advanced strategies. I'll see you in the next video, and remember, smart traders trade the structure, not the noise.